All right, Eel Nerds, episode 172. You can see the storm brewing outside the New York Stock Exchange, and the market is very volatile. But I have figured out a very simple methodology to invest in equities during this volatile environment, and I will share my secrets and would love to hear your feedback. We are at 480 subscribers. Thank you for your support. There are several playlists that you can look through, and the topics range anywhere from preferred stocks to municipal bonds and so on. And if you are a beginner to the show, please use the income investing roadmap. That is the best place to start. Most importantly, please remember that I am wrong many times, so do not take my word for it. Please do your own checking. Well, four parts today. The first is the market temperature and talk about that volatility some more as I lay my money on the steps in front of the New York Stock Exchange. Thank you, Bing Image Creator. And, I'll compare my performance with that of the market as always. And there is a $5 trillion money gun that is coming to the market in short order, in 14 days. We'll talk about that. And I will share the crux of today's show, the methodology I developed to pick stocks during volatility, and I will share my results. And let's get started. Well, first, my equity portfolio is returning a really cool 10.5%. I am super happy with the 10.5%. And that is over the last 3 months, and the last 4 weeks have been even stronger, but we'll stay with the 3 months for a fair comparison. The reason I say fair comparison is because if you compare me with the NASDAQ, you may remember the NASDAQ had that huge crash 3 months ago. And since then, the NASDAQ has trounced everything else. It grew at 27%. I was not smart enough to buy the NASDAQ portfolio as 100% of my equity allocation. But hey, I'm happy with the 10.5%, and I believe I should fare, reasonably well moving forward. We will see. Speaking of my equity allocation not being 100% NASDAQ, just so you know, I used to be at 0.5% of equities. I am now north of 3.5%. That still means an overwhelming majority of my holdings are in fixed income. Well, the equities themselves have only one sector where I am underallocated significantly, and that one sector is consumer discretionary. And everything else I've pretty much caught up with recommendations. So, what is this $5 trillion bazooka we talked about earlier? And before I review some more, I want to make sure you know that I am not a tax investment advisor or a tax advisor. I'm not a wealth management advisor, and I don't have an agenda, politics, or product. So please take everything I say with a grain of salt. Well, there is a debt storm of sorts coming. This is Treasury Secretary Bessent, who said, hey, by the way, this is called the Treasury News from the Department of the Treasury. They said, hey, we're going to be, the debt limit is now higher by 5 trillion. And so in the next 2 weeks, this is the July order. In the next 2 weeks, we're going to start issuing more short-term treasuries, specifically 4, 6, and 8 week bills. So I'd be very curious to see how the market reacts to the 4, 6, 8 week bills. And that is going to be at the end of July. And so at the end of the week of July, in the month of July, into August and September, we're going to see a huge amount of short-term treasuries come in. And the Treasury is saying we're going to make sure that it doesn't pump the market up too much, and we'll provide more updates. And I, for one, 96% of my allocation in treasuries, I'm waiting to see what that does. Well, so here is what this does. The Treasury then put out the usual inquiries. Now, what is an inquiry? The Treasury says, hey, we don't really want to issue longer dated debt. Now, why would they? Because the interest rates are, as you know, north of 4.25%. There is a lot of spirited debate, we'll put it that way, on bringing interest rates down. And if interest rates come down, you would rather refinance at the lower rate than a higher rate. And so Treasury Secretary Bessent is making it very clear we're going to issue most of our stuff in the short term, They will be bills, they will be less than 1 year, and a year later, or somewhere there, when there is possibly a new Treasury Secretary, I mean, when a new Fed chair, they would argue to lower interest rates significantly, and at that time, reissue the debt at a lower rate. And so they're kind of telegraphing what they are going to do. There isn't going to be a lot of long term coming in, and there will be a ton of short term coming in. So what is another dealer input? They said, hey, we have this thing called the Treasury Buyback Program and Cash Management Program, a fancy way to say, if you don't buy our extra short-term debt at an attractive interest rate, we will buy it ourselves and print more money. That's a pretty cool thing to telegraph. And so it effectively says either you buy it at prevailing rates or somewhere very close to that, or we will just print more money and deal with it. But can you please, pretty please, buy our debt? That's what it says. Well, so what could this mean? And I'm going to go to this Nirvana scenario of what this could mean. Turns out there is plenty of extra demand for short term. Hey, I for one will be buying it. And people have figured out, well, rates are going to fall in a year. Let me just enjoy the ride between now and that time. And so there is a lot of demand. Foreign demand, we make peace with all the people that we are, having some level of tariff discussion, so to speak. And they say, okay, we'll play ball and we'll buy your short-term treasuries as well. And notice stable coins, which the US is bringing to market. Stable coins will also play a role here. The CRCL, Circle stablecoin, and the Tether stablecoin are both going to be backed by US treasuries, again, short-term treasuries. So all of these are intended to stabilize the price of the short-term treasury, and I'll see where that goes. And in the Nirvana scenario, we smoothly go into more debt, 5 trillion more debt, and short-term rates staying kind of sort of the same. That's the Nirvana scenario. Well, what's the nightmare scenario? Well, if you pump in 5 trillion more in the 4 week and the 6 week and the 8 week, maybe some people don't want to own the 4 and the 6 week. They may conclude the exact opposite. They may say, well, I know you're going to drop long-term rates sooner or later, maybe a year out. So maybe I want to buy that now before it drops too much, which means I don't have a lot of short-term demand. If I don't have demand and I have more supply, then yields will go up. What else? Well, if you don't buy, the Treasury is already saying we're just going to print more money. If they print more money, then debt increases. If debt increases, then you have to issue more debt to cover the interest of that debt. We create a vicious cycle. And when the market sees that there isn't enough demand for short term, then long term goes even higher. And a lot of funds, hedge funds, a lot of those, they may own some 10-year as a hedge. If you own 10-year as a hedge to cover your position that you have leveraged, and the 10-year drops in price, meaning the yield increases, then you're going to have to sell that to cover your margin. And if you sell that, then you are going to rock the boat even more. In order to cover your position on the 10-year, the only thing you can sell isn't the 10-year. You're going to have to sell stocks to take your money out. And if you sell stocks, then the market will crash. Now, which one of these two is more likely to happen? I don't know. If I did, I would take that position. But as you can tell, I am very risk averse. Yes, I do own 3.5% of equities, but the vast majority of my holdings are in treasuries, 67%, and they are under a year. I do have some agency bonds and I have some muni bonds, and those are all, taking a loss, a paper loss, but I don't intend to trade them. I'll hold them to maturity. My thesis is that when long-term rates eventually drop, the muni bonds that I bought now, which pay more than 5% and are federal tax free, will appreciate in price, and I will see how that goes. So that is the bet that I'm taking. But how do I invest that 3.5%? Let me tell you more. Well, you may remember, and I'll beat this to pulp, I have two filters that I run every day. The very first thing says, I just want to pick companies that grow very, very fast. And the reason I say that is when a company grows fast, then it has a bigger share of the indices, whether it's part of NASDAQ, whether it's part of, Russell. So higher growth, that is what this filter measures. It says, show me companies that are growing fast in the last 3 years, growing fast in the trailing 12 months, and are expected to grow fast. So this is the creme de la creme. And also they have a very healthy market cap. And so once I run this, I get a series of companies. I'll tell you more about those. Then I run a second filter. This filter says not only do I want companies that are growing fast, but I want those where their stock price is increasing slower than their revenue growth. That means their PE ratio is more attractive than otherwise. And so when I look at these two filters, I then pick the ones that come from here. I do a little bit of macroeconomic analysis and I start buying them. Well, how do I buy them and how do I think about trading during volatility? I try the first method and I'll share that method. And this is called buy the dip. It's very, very scientific. You buy it on day one. If the price decreases on day two, you buy it on day two. If it decreases on day three, you buy it on day three. If the price increases, you stop and watch it go up. Now remember, I only do this on stocks for the most part that meet the filter. And so this is the buy the dip. The second caveat here is how buy the dip works when the stock just goes up, 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 and up. You buy the very first time, because you're waiting for the dip, you sit out that beautiful, magnificent appreciation. That is the challenge with that approach. It protects the downside, but at the same time, you don't get any of the upside. And you could say it protects the downside, but if it is a falling knife, then you're still going to get caught. So in cases where there is volatility, here is the same stock going up. You only caught one small bit of it. You did not buy the upward trajectory. You again buy the downward trajectory. And at the end of the day, you can have any methodology you want. Let me tell you what happened when I tried this methodology. Here is Modine Manufacturing. You can see that pattern evolve here. I bought, and then the price went up. I stopped, the price went down. I bought, the price went up. And so this creates this ununiform gain for me. And in cases where it's a falling knife, where I keep thinking, oh yeah, I should just keep buying more of it because it is dropping today, the buy the dip doesn't always work if the stock is crashing. I learned that lesson the hard way. Here is Bloom Energy. It's a very good company, except it's another falling knife. Every time I buy, because the price of the stock crashes, it bombs the next day and the next day, and I'm hurting. Here is my bottom of the barrel where I did two mistakes. I either bought stock based on the fact that they made the news in a certain way, they had a big crash, and I think, oh, I'm going to buy the dip, or I used the methodology I reviewed earlier, and both of them led to my holding more and more of stocks that were going down, but I never benefited when the stock came up because I wasn't buying at the time. So I learned from my own actions and made a small tweak. Here is the small tweak. I buy on day one. If it goes down from there, I don't buy. I sit and wait until it starts going up, where the current price is at least higher than the previous buy. It's that simple. I buy when the current price is higher than the previous buy. And here is the same stock on the vertically upward trajectory stocks. Look at that. I get to buy it at every single point along the way. And stocks that have the up and down, I get to buy it every time it goes up. So even when it comes down, I'm only getting bit on a portion of it. I still benefit from the gains on the first two. How did that work? Here is an example. This is Ouster. The very first time I bought, I paid $10. Every time it went up, which turns out it went up 7, 8, 9 times, I kept buying it. Here is my gain on that, 125%. Now, I can give you one stock and say, there you go, this is right. Can I do this at scale? Well, here is Appfolio. Appfolio, I bought it, the stock went down, and I stopped. The only way I would buy this again is if the price goes up about 253, I'm sorry, 255.56. That is when the previous trade would be in the money. And so this is the general thesis. The question then is, did it work or did it not work? Are you ready for the drum roll? I told you buy the dip hasn't worked for me. Do you want to see if the small tweak where just looking at the previous trade and making sure it's in the money? Let me tell you how it did. And here are my holdings after making that simple tweak. Here we go. My gains are anywhere from 125% to 16%. Every one of those meet the filters. I buy a small tranche on day one. I only buy if the previous purchase is in the money, otherwise I stop and I repeat it. The end, no additional tweaks, and that has produced great dividends ranging from 120 to 5%, but in aggregate, it has created a great return for me. Now, then the question is, if I kept following it, when do I sell? I again go to filters to tell me when to sell. So in this scenario, if the stock price is falling where the market cap drops below a threshold, it will not match my filter. When that happens, I sell it. The second scenario is if the stock price rises faster than revenues and it falls out of that filter, I sell. Those are the only two cases where I sell. Otherwise, I buy and hold, and I have my methodology of when to buy and when not to buy. That is me. I am sure you have your own methodologies. I would love to learn. Thank you for watching, Gilbert.